So we've already talked about how the long-term rates move with the short-term rates, right? They move together. The 3-month is more, the short-term rates are more variable. 10-year rates are usually higher. Daily data, we see this. Monthly data, we see this. The reason is the long-term rate is an average of the current short rate and expected short rates, and then a premium because the long-term rate is riskier, an interest rate risk sense, and also a liquidity sense. The long-term bonds are usually a little bit less liquid than the short-term bonds. So we've gone through all of that. Where we went then is that the short-term rate is driven by monetary policy. Central bank sets the short-term rate. They have that ability to do that. They are the issuer of reserve balances, and reserve balances are what banks borrow and lend in the federal funds market. So the Fed has the ability, and every central bank does this, to set that interest rate because those balances are liabilities of the central bank. Stated a different way, if you're the one that prints the money, you are the one that also sets the terms for people borrowing that money. So that's what the Fed is doing, short-term interest rate. Now, the Fed is not actually setting the 3-month T-bill. It is setting the federal funds rate, but the 3-month T-bill moves with it. You can see here, especially the last 34 years, something like that. Okay, it doesn't move exactly with it because it's a 3-month rate. The federal funds rate's an overnight rate. And so the 3-month rate is going to have embedded in it what the overnight rate does for the next 90 days. And so they're not going to be exactly the same, but statistically, they're basically the same. Saying then is the 3-month rate, we can think of it as effectively the Fed's target rate, okay, because it's going to move with it. And so then when we see something like this, right, we see this 3-month rate being the blue and the 10-year being the red, you can see that the red is following the blue. Not always, right? We have these little ups and downs and such. And that, when you see that, that means we are being driven by expectations of the 3-month rate more than anything. Okay. When you see it doing these kinds of things, even when the short-term rate's doing nothing. Okay. That is these rates over here really moving around. So we see that here too, right? The Fed was raising the short-term rate and the 10-year didn't go up as fast. And in fact, the 3-month rate went above the 10-year for a while and still is above the 10-year. And so that's telling you again that the short-term rate went up higher than this one because these expected rates were saying, the markets were saying, we don't think you're going to keep the short-term rate that high for very long. Okay. All right. So we did that. One of the very famous things to do is to look at the 10-year relative to the 3-month and take the 10-year rate and subtract the 3-month. So that is basically taking the space between these two, right? The 10-year and is the red and the 3-month is the blue. And so 10-year minus the 3-month and just plot it. Okay. And you can see here that it goes below zero right before these shaded areas. The shaded areas are recessions. And if I went back another 30 years before this, it would do the same thing all those times. It would dip below zero a little bit before the shaded area. So historically, this is our best predictor of a recession, okay, when this rate goes low. Now, interestingly, the markets had never gotten this wrong. Almost here, if you on a daily basis, this is monthly data, but on a daily basis, this did go below zero. So but this goes below zero here because of the Asian financial crisis. So that was a rush to safety. Everybody leaving corporate bonds and moving to treasuries, longer term treasuries. So that's going to push prices of treasuries up and interest rates on treasuries down. So that's that's not really a forecast. That was sort of a rush to safety and liquidity. Another way of saying that is that's partly the K falling. If I look at the formula, it's partly this K falling rather than the expectations falling so as much. But what's going on over here again is the markets, first off, look at how low that's been. The markets really were thinking the Fed was overdoing it. And notice the jaggedness. So they've really thought at different times the Fed was going to cut rates and then realized, no, Fed's not going to cut rates and moved it back up. And then they think, well, Fed's going to cut rates. So they move it down. And then, no, Fed's not going to cut rates, move it back up. And so they're kind of, they've basically not been very good at all at forecasting where the economy is going and where the Fed is going with respect to that. So this is why the Fed has been saying a lot of things while it's been raising rates. And then for the last year and a half, since spring 2023, it had not raised rates. And so we can see this here, right? It had not raised the rate since spring 2023. It was just staying there. So this 10-year, they were trying to figure out what is going on, when to expect the Fed to be cutting. And the Fed was trying to say, we're going to keep this up here until inflation gets low, and we're really sure that it's going to stay low. And so that's why they said things like short-term rates are going to stay higher for longer. That was sort of a keyword, a phrase that they were using, higher for longer. And that was an attempt to get these rates to stay up by saying that, to get these rates, Fed's controlling this one. They're trying to get these rates to stay up because they're saying, expect us to keep short-term rates higher for longer than you think we're going to. And then that should have brought this one up. And so you can tell sometimes they were successful because that whenever this goes up, that means the difference between them is shrinking, and that means the long-term rate's going up. The markets basically missed the Fed on that one. And they also misforecast the inflation, but most everybody did. But it's interesting going forward because I've been teaching this stuff for almost 30 years. And this was always the predictor. And I always told everybody, watch this one. And the other thing that happens is when this goes below zero, you'll see all the pundits in the financial press say, oh, the bond market's in a bubble. By bubble, they mean because interest rates are so low on bonds, that means the prices of bonds are really high. And so they think that's a bubble. And I've told classes for years, I've said, when you hear people say bond markets are in a bubble, that's a sign that they don't know what they're talking about, and the bond markets do, because the bond markets are probably correctly predicting a slowdown. That worked for me for 30 years until here. And bond markets have gotten it wrong. So anyway, the next one that you frequently watch is the 10-year minus the 2-year, because the 2-year is the red. That's going to lead. That's going to tend to move with the 10-year minus the 3-month, but it's going to tend to lead because it's also got some embedded expectations, whereas the 3-month doesn't. So you'll see it won't go as high and it won't go as low or get down there. It will tend to be dipping sooner. You can see that happening. It's dipping sooner. But interestingly, again, the 2-year was still below zero here. Again, nothing like what we'd seen. This is kind of an anomaly here. So again, there are videos on all this stuff about what the markets were saying that I've gone through. Okay, this is what I put together last year about what the markets were saying through the yield curve. So, but what I want to do is this, and we talked about this a little bit already, but I want to get this onto a video. So here what we see is 12/15/2022. So the end of 2022 is this green. This is the yield curve. So this is about where the Fed has the interest rate set. Okay, somewhere in here, right? It goes up. Well, this is an expectation that the Fed's going to be raising rates. Okay, and they were correct. Fed's going to be raising rates over the next 6 months to a year. Okay, then it goes down. Expectation the Fed's going to be cutting. That was 12/15/2022. Within 2 months, it had gone up because Fed raised rates. They were correct. And again, expectation of the Fed raising, but you see this isn't as steep as this one. So they're thinking Fed's close to done. They were correct. And coming down, right? So it's just kind of a space between these of about 0.5%. It's about right. Fed raised rates about 0.5% over that period. Okay. Middle of 2023 or the end of July 2023, Fed had raised again. Okay. By what, another 0.75, something like that. They'd raised again a couple times at least. This now, right here, is the market saying what? The market's saying Fed's done. Fed's not raising anymore. Okay. And in fact, you see the 1 year coming down. That's the market saying Fed's probably cutting between 6 months and a year. This is July 2023, end of July. They were darn close. They were about a month or two off. So they were pretty close. That is when the Fed cut, was September 2023. Right around here is this is about the first time the market started to get it right. Let's see here. What was going on here? This is saying no more increases. This is saying a cut between 1 and 2 years. This one was correct as well. This red one was correct. I don't know if they're correct about how low the Fed's going to cut rates. That's what is embedded in these expectations. We'll have to wait and see. This, though, was saying 6 months to a year in December. This was wrong. This was wrong. That the Fed was going to start cutting between 6 months and a year. That was wrong. The red was when they started to get it right. And then this was right as well. This over here, these are the same, right? Obviously. But this is actually in the purple an expectation of a lower interest rate in the future because the current rate is higher. Okay. So if you have the rate, let me show you that on the formula if I can find the formula. If this rate's the same in two different periods, but this rate's different, then when this rate is higher, these rates have to be lower to get this the same as the previous period when this was lower. Okay, that's all I'm saying. It's interesting because the markets changed their view on how much the Fed would cut. They got right when the Fed was going to start cutting. They got that right, and they had it right as well. But they actually started to expect even lower cuts. Now, the Fed did not like that. Fed did not like that because the Fed's still trying to squeeze inflation out. They think they're done raising rates, but they still need to squeeze more inflation out. This is July 2023. And so the Fed does not like that these markets are basically calling the Fed's bluff, saying you're going to have to start cutting, right? And so what does the Fed do? The Fed starts announcing the higher for longer policy, saying we're going to keep short-term rates higher for longer. Okay. And I put here 10/19/2023 because this is the peak. You can see here, this is only 2.5 months space between these. So it's identical to this point and then up. Well, that's a forecast by the markets that the Fed's going to keep short-term rates up here for longer than they were thinking 2.5 months earlier, that the Fed would keep rates up here. Okay. So that was the Fed saying, we don't want long-term rates to be low that quickly because we don't want mortgages to start taking off and everything again, speeding up the economy and threatening the inflation that we've worked so hard to bring down. So that was what the Fed was doing when they said higher for longer. Okay. But the press came out, this move over 2.5 months from the purple to the blue was interpreted by some in the press as a rejection of US treasuries, right? Because they're basically saying, well, you were issuing a 10-year at 4, now you have to issue a 10-year at 5, right? And so that was the bond market saying you're issuing too much debt. That was always wrong because that isn't what drives these rates. These rates are driven by the Fed and expectations of the Fed. That was wrong, and I knew it was going to be wrong. Okay. So, but here is the guy, and I actually have used this guy's work in my classes years ago. He's very good at forecasting the economy using the data that's incoming and such, but he was just dead wrong here. He wrote this article and he said the yield curve, blah, 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 blah. Bond yield has gone vertical in recent weeks, jumping to 4.8%. If it continues to soar up to 5% or higher, that's what it did, right? Yellen, Secretary of the Treasury, should meet Biden to explain that bond vigilantes are about to trigger a crisis. So he's saying, oh, we have a crisis right here because the bond vigilantes are starting to reject government debt and it's just going to get worse. And these rates are just going to go higher. That's going to raise the cost of government debt and debt service, but that's also then going to start to affect mortgage rates and all the other rates that price off of these. Okay. And so you're going to be disastrous for the economy. Okay. So that's what he's warning against. Well, I knew that was wrong. And I have a Financial Times account. I am kind of known in some of these circles, so I don't always like to put my own name out there. So this time I was Taco Bob. And my response to his article, the yield curve is still inverted at 5%. It would still be inverted. That's not bond vigilantes. That's markets pricing in some of the Fed's higher for longer. Can we all stop freaking out about long-term rates rising less than 0.5%? That's how much they had risen, right? By then, I mean, by October 19th, they rose a full percentage point. So 2 more weeks, they rose another half a percentage point, which is what Yardeni was warning against. He said that was going to be awful, et cetera, et cetera. But my point was, if you're a bond vigilante, meaning if you're rejecting government debt because you're thinking the deficit's too high, why on earth are you allowing them to issue a 10-year at 5 when the 3 month is 5.5? Because look at the formula. Let's go all the way back to this formula. Even if you don't believe this formula, there is a premium. There is more risk to a long-term rate than a short-term rate. Okay. Because the interest rate risk and that's less liquid. So think, even if you're thinking like Yardeni, which is that these expectations aren't driving the rate, it's the market's views on the government debt and such. In that case, these should basically be long-term rate should be at least as high as a short-term rate and probably higher because it's riskier. Okay, there's no reason in the world for it to be lower. Makes no sense at all for a riskier bond to be lower if if the bond markets are rejecting government debt. So that's why I said yield curve is inverted at 5%, it would still be inverted. And I was right, right? It did get to 5% and the yield curve was still inverted. That's not bond vigilance, that's markets pricing in some of the Fed's higher for longer. Okay. What happened? Well, 2 months later, the orange. This was where we were, this blue, when things peaked. 2 months later, we were down to the orange. Nobody talks about bond vigilantes anymore, all of a sudden, which is hilarious, right? Because the next time this happens, the next time these long-term rates go up, you're going to hear bond vigilantes all over again. And all of them will forget that they were all wrong about bond vigilantes last October. And it's not like the bond vigilantes are going to run away or suddenly between late October and late December say, "Oh, government debt's not so bad. We'll let you lend. We'll let you borrow at 4%. We'll change our mind." Right? I mean, that makes no sense. The markets aren't going to go, "You can borrow at 4," and 2.5 months later, "You can borrow." No, now you have to borrow at 5 because we're worried about the debt. And then 2.5 months after that, "Oh, you can borrow at 4." That's not, I mean, if you're rejecting government debt 2 months later, you're not going to like be okay with it. It's not like they stopped issuing it or started issuing less. There was no reason for that. And so the explanation for what happened is that this is driven by expectations of the Fed. And then we watch, and so I had this one, the orange, which was a bit below 4. So the orange, bit below 4. It went even a little bit lower by February, so 2 months after that. And then the Fed cut in September. And notice what's going on here. It's even lower. Okay, 10-year is 3.75-ish. Now, what's going on here, why this is getting more of a U shape, is because now the Fed's starting to cut. So you're in that period where the Fed's cutting. So we're starting to price that in more sooner than we were here. So that means these rates are getting lower. These ones are going to go up a bit more quickly because they don't have as much Fed cuts embedded in them anymore because those cuts are coming down here. So then, just a little bit later, we get this other article. Bond vigilantes were back, declared Ed Yardeni, blah, blah, blah. But yields then fell sharply. Markets shifted from fears over when and how fast the Fed will cut them. Well, no, they didn't, because it was always about when and how fast the Fed will cut them. They just thought the Fed wouldn't cut them for a while. And then they changed their minds in late December about when the Fed would cut because the inflation data was coming in, it was looking better. And so the Fed kind of eased up on the higher for longer talk, and that changed the way the bond markets were viewing things. This was me writing about this, about what the markets were expecting at all of these points. Let's look at the most recent one. They're saying the Fed's going to continue cutting. So we're about right here, 4.7-ish for the short-term rate. We were at 5.5. 6-month rate in 6 months, meaning I used these two rates to figure that out. It's 3.3. Okay, the rate in between these two, 6 month and the 1 year, 6 month. So 3.3. So they're saying a short-term rate in 6 months. So March, it's going to be 3.3. I think that's way too low. I don't think there's any way the Fed's going to cut rates that fast unless we hit a recession. I think that's way too low. And the 1 year rate in 1 year, so 1 year from now, a 1 year rate at 3. Again, I think that's a bit low. If we go into recession, absolutely. Or if, we have all these wars going on, create some sort of chaos, etc. Yeah, that can happen. But just the economy going on the path it's on, and we don't have some big recession, even if we have a slowdown, but we don't have a big recession, I don't think there's any way we get that low. It's going to take some significant event for us to get that low. I think the markets are kind of wrong. I don't think that's what the Fed's going to do. And then I did a little bit of longer term rates. And it's interesting. What I'm showing here is that between December 2023 and November 2024, sorry, September, the market's view of the longer term, where the Fed was going to get to when it stopped cutting rates, how low it was going to cut, remained unchanged. 2 year rate in 5 years, okay, which would be pretty comparable because we're only about 8 months apart. They had it 3.5. A 2 year rate in 3 years, they had it 3.3 in both cases. Okay, ish. Because the K in this formula it's not exact. I have to guess what that is, but it's going to be small enough at those shorter term, those intermediate interest rates that I can guess. It's interesting that the market's views of the longer run did not change. It was just basically pricing in when the Fed was going to cut. Okay. Now, this is interesting because they definitely had the Fed in October raising rates. So look what's going on here. July 2023. Pretty fairly comparable. 2 year rate in 3 years, 2 year rate in 5 years, 3.6, 3.7. We're at 3.3, 3.5. Some of that's because we are about 5 months difference here. So there might be a little bit of a difference with the Fed being expected to keep rates high over that period. That could explain some of it. But these are pretty similar, right? The only one that's different is this October one. And this is them pricing in the Fed keeping rates about 1.25 to 1.5 percentage points higher. And then deciding a few months later, no, they're not going to do that actually. So, and they've kept the same views. Fed was saying repeatedly it would keep its target rate higher for longer, which led bond markets to price in about 1 percentage point higher, maybe a little more. Yield curve remained inverted throughout. Longer term rates were always below the short rate. This can't be barred in vigilantes. Hard to believe they wouldn't demand more for a long-term bond than an overnight if, in fact, they exist, meaning bond vigilantes. They don't. Not in a highly liquid market like we have. Within a few months, rates across the yield curve returned. So again, hard to believe bond vigilantes would only be in action for a month or so. The government's budget didn't improve. No reason for them to leave suddenly.